Greetings and welcome. I'm Professor Denver, and thanks for watching my presentation on basic accounting in alignment with the chapters in my book, Accounting 101, Easy Accounting and Bookkeeping for Beginners. This session is about concepts presented in Chapter 2, Business Transactions, Chart of Accounts, and the General and Special Journals. Business transactions are activities performed on behalf of a firm that are measured or valued by money. Business transactions are expenditures or expenses or receipts for goods or services for cash or contractual obligations to be paid or received at a later date on terms. These business transactions are recorded by the accountant in the books of the business on journal entries guided by the chart of accounts. Business transactions are usually supported, evidenced, by documents such as invoices, bills, receipts, notes, cash, contracts and written agreements, shipping documents, receiving reports, and the paper or digital computerized statements, etc. It is important to distinguish between personal transactions of the owners, such as for groceries, clothes, traveling, gasoline, etc., and those of the business on behalf of the business as an independent organization or entity separate from the owners, such as for office and warehouse rental, purchase of inventory for resale, sale of merchandise and services, loans from banks, loans from owners, loan and advances to owners or employees, purchase of office supplies, etc. The business is treated as a separate, non-organic person in the eyes of the law and referred to as a business entity. Business transactions are generally between 6 main pairs of give-get categories of general ledger accounts of a business organization. 1. Assets to assets, such as cash received on account from a customer and involving a debit to cash and a credit to accounts receivable. 2. Assets and liabilities, such as a payment by the firm on account to a supplier or vendor and involving a debit entry to accounts payable and a credit entry to cash, or purchase of inventory on credit involving a debit to inventory and a credit to accounts payable. 3. Accounts and expenses, such as cash payments for rent or utilities or office expenses, involving debit entries to expense accounts and credit entries to the cash account. 4. Assets and revenues, such as cash sales and sales on account or on credit, involving a debit to cash or accounts receivable and a credit to revenue or sales accounts. 5. Liabilities and expenses involve expenses that have been incurred by the firm but not yet paid, including salary and other payroll expenses, taxes and other withholdings, lease, utilities, etc., not yet paid but accrued by the firm. And 6. Assets and equity. These include transactions usually between the firm and owners and investors, such as cash received as capital invested in the firm or convertible stocks and bonds sold to investors, involving receipt of cash by the firm, debiting the cash account and crediting equity accounts, or a combination of them. Note that transactions between the organization and parties inside or outside of the organization, such as employees, debtors, creditors, banks, and owners, are recorded in the general ledger accounts of the organization, accounts receivable, accounts payable, long-term loans, owner equity, etc. A chart of accounts. Let us look at the structure of the combined chart of accounts and the trial balance, and imagine moving money, financial transactions, out of credit, one general ledger account, and simultaneously into debiting another general ledger account. A chart of accounting is a list of general ledger accounts set up and used in business firms to identify, record, and post financial transactions conducted on behalf of the organization. Creating and setting up the chart of accounts is usually among the first set of activities done by the accountant, along with setting up a new bank account for the business. Notice how the general ledger accounts are numbered and classified in the chart of accounts. The balance sheet section of the chart of accounts contains subcategories listing asset account numbers beginning with the number 1, liabilities account numbers starting with the number 2, and equity account numbers starting with the number 3. The ledger accounts in the balance sheet section are called permanent accounts because their balances are carried over from one financial period to the next. The income statement section of the chart of accounts shows subcategories listing revenue account numbers beginning with the number 4 and expense account numbers starting with the number 5. The ledger accounts in the income statement section are called nominal or temporary accounts because their balances are closed out to zero by transferring their totals to an income summary account at the end of each financial period. The next financial period begins with 0 amounts in these accounts. The combined chart of accounts and trial balance shows the normal types of balances, debit or credit, found in accounting systems with asset accounts, debits, contra assets, credits, liabilities, credits, equity accounts, credits, expense accounts, debits, and revenue accounts, credit. The General Journal. The chart of accounts is used to analyze and record business transactions in the journal. The General Journal is often called the book of first or prime entry because this is where the business transactions are usually first recorded in the books of the firm. Accountants use the chart of accounts to aid in analyzing business transactions to identify the give-get relationships of the transaction and determine which general ledger is receiving the value, debited, and its source, where the value is coming from, crediting. Journalizing a transaction is the accounting jargon used to record entries in the journal and involves debiting, recording values in the debit section, and crediting, recording values in the credit section of the journal. It is important to remember the double entry concept to ensure the journal balances. Special journals may be used by mid-size and large organizations that conduct several similar kinds of business transactions daily, which would make it cumbersome to record all transactions using general journals containing multiple lines of information and general ledger account numbers for repetitive types of transactions. Special journals are journals containing pre-numbered general ledger account numbers across the top of the journal for the general ledger accounts to be debited, along with the corresponding general ledger accounts to be credited in single rows for each transaction, and are posted to the general ledger periodically in batches. 5 common types of special journals are: 1. Cash receipts journal, in which all receipts of cash and checks are recorded. 2. Cash payments journal, also called cash disbursement journal, in which all payments of cash and checks are recorded. 3. Purchases journal, in which non-cash purchases are recorded. 4. Sales journal, in which non-cash sales are recorded. And 5. Payroll journal, in which salaries and wages of employees are initially recorded for the period. That is all for now. Thanks for watching this presentation.